Ladies and gentlemen, welcome back to the conference room for the fifth session of the Marrakesh Economic Festival. This session is about de-risking the global financial and trade system. It is jointly organized by the Policy Center for the New South, the Reinventing Bretton Woods Committee, and Friedrich Ebert Stiftung. Please welcome to the stage the moderator for this session, Abdelaziz Aitali, Head of Economic Research at the Policy Center for the New South. And the speakers for this session, Paola Subaki, Professor of International Economics at the Global Policy Institute in Queen Mary University. Shaheen Valle, Senior Fellow at the German Council on Foreign Relations. Ralph Osa, Chief Economist at the World Trade Organization. And Eric Bergloff, Chief Economist at the Asian Infrastructure Investment Bank. Now, the session will begin with opening remarks by Sarah Burke, Senior Policy Analyst at Friedrich Ebert Stiftung in New York. Sarah Burke, the floor is yours.
Welcome, everyone. Thank you for taking the time to come to the Marrakesh Economic Festival. I'm Sarah Berg, Senior Policy Analyst at the Friedrich Ebert Stiftung in New York. We're a publicly funded think and do tank based in Germany with over 100 offices around the world. I want to offer warm thanks to Mark Uzon, wherever he is here today, and the Policy Center for the New South for their work on an extraordinary program for the next few days. Mark, Paola Subaki, and I have been talking with the IMF since before they released their paper on geoeconomic fragmentation earlier this year. And we've been urging them to take a greater focus on the impacts to the international monetary and financial systems, and not only the trade system, which they have looked at quite extensively. So as we urge them to delve deeper, I wanted to let you know that we've commissioned Paola Subaki to write a report on de-risking, and on your tables there's QR codes if you're interested in downloading the executive summary or the full report. That's really all I have to say. Thank you so much for your attention, and I hope this is going to be a great discussion. Thank you.
Abdelaziz Aitali, the floor is yours.
So thank you, ladies and gentlemen, esteemed panelists, distinguished guests. Let me first extend my warm welcome to all of you who have joined us to discuss this critical and multi-faced issue of fragmentation. And to do so, we have gathered a diverse and impactful composition of speakers representing think tanks, academia, policymakers from the regional and international institutions. And the topic at hand represents actually a complex and intricate landscape, replete with the nuances that requires actually our close attention. We are confronted to various forms and manifestations of fragmentation, from the Derisking to something much more extreme. It's also a dynamic phenomenon that affects the global financial and trade system that poses substantial risks to our common future. And to discuss all this, I will start with our first speaker, Ms. Paola Subaki, who is Professor of International Economics at the Global Policy Institute in Mary Queen University. And for those who want an extensive biographies on our speakers, they are on our agenda. And we'll start with the beginning. So a lot of people actually tends to say that this fragmentation is actually overstated, that data do not actually reflect what some politicians are talking about. So to what extent actually fragmentation is manifesting itself on the ground?
Well, thank you very much. You are absolutely right. The data still shows that we are deeply integrated. And we are deeply integrated, and particularly this integration happened over the last 30 years, since the early 1990s, and is on basically thanks to cross-border trade transaction and capital flows. And we are still integrated, and the data are very clear. And again, the report that Sarah Burke mentioned gives plenty of this data. So in historical terms, the global economy never been so integrated. Obviously, there have been changes in the level of international trade and also in capital flows. But that's the first point. The other important point, and we need to stress when we talk about integration and then fragmentation, or risk of fragmentation, is that the global economy revolves around the dollar. We discussed the role of the dollar in the global economy in the previous session. There were very interesting discussion among the central bank of South Africa and Colombia and Peru. And so the dollar remains the key currency. And it's not only the key currency, it's literally the dollar holds the global economy together. And so that was been very much the starting point of the report that Sarah mentioned. Obviously, with integrations, we have vulnerabilities. So vulnerabilities are the other side of the coin, the same coin. And so vulnerability existed 30 years ago, the moment we become more independent, economies become more interdependent. Obviously, we were less concerned because we didn't face, let's call it, a hostile geopolitics. So therefore, it was when everything works well, when you are happy with your neighbors, you don't feel any constraint, then you feel that interdependency is not a problem because it's fine, it's good. But interdependency means potential vulnerabilities. Now, the pandemic first, but then the war in Ukraine have very much exposed the problems with these vulnerabilities, and particularly on commodities trade, but generally on trade and finance as well. So, and that, with vulnerabilities, that's the point of what do we do about it? How can we mitigate the risk that comes from vulnerabilities? How can we de-risk the global economy? And the response has been very messy, I would say, and with, to some extent, also there was a lot of panic and saying now we need to stop becoming too close to some countries than to become that might not be particularly friendly. And so the response has to be absolutely much more balanced, and certainly we talk about de-risking, and this is the word as opposed to protecting or protectionism, even protectionism. So what do we do? The risk here, and why I stress this point about de-risking and non-decoupling, for example, is because de-risking means creating resilience, which is good, because we need to be resilient and we need to be aware of these vulnerabilities. But the risk of going too much into, let's call it hostile and confrontational response is that we risk undermining international cooperation. And that is critical, because international cooperation is what helps us to manage cross-border issues and what we call international public goods. So in the report that Sarah mentioned, so we tried to think about fragmentation and particularly where they are the issues. And we said the report is based on one important point, which is China has changed the dynamics of the global economy. We won't be talking about fragmentation if China won't be here or not be what it is now. So, and to use the definition used by the European Union, China is a competitor, a partner, and also a rival. And so China is all these three things all together. And obviously 30 years ago, we had a different dynamics, and different dynamics in global trade and in global finance. Now, this has changed. And so we need to think about how we can engage with China, which again is challenging. Now, to the report, and then I will stop here not to take too much time. Maybe we can then discuss our recommendations. There are two areas we examined to really identify the risk of fragmentation in international monetary system and international monetary and financial system. One is the extent of debt and sovereign debt, and the fact that there is a huge fragmentation already in how debt is distributed in terms of bilateral, multilateral, concessional, non-concessional, private, public, and so on. And that has made debt resolution and generally managing debt much more complicated. And this is an area that involves the multilateral international financial institution as well. And the second area of our research and analysis is digital currencies. So again, back to the point about the dollar. China has been developing and internationalizing his currency since 2010, and that is right, because a big country, big economy, a big exporter, so that. But obviously with limitations, and I'm not going to delve in this limitation. We might discuss later if you like. The reason now, and obviously the the actual renminbi is face-to-face and head-to-head with the dollar. So that is definitely the dominance of the dollar. But the area where China has a competitive advantage and substantial advantage is digital currencies, where actually China has developed these technical innovation and platform and so on in a very sophisticated way. So this is the area where the international monetary system can become fragmented if we end up with different systems and different standards, rules, and even technologies. In particular, if the digital currency become usable in cross-border trade. And so, and this is the area we identify where fragmentation is happening or will continue to happen and where we need to mitigate the risk.
Thank you. Thank you so much. So the challenge will be to strike this balance between integration and safeguarding resilience. So let's now turn to our second speaker, Mr. Shaheen Vali, who is a senior fellow at the German Council on Foreign Relations, to share with us the experience of Europe, or at least what this fragmentation means for Europe, what are the different implications of this phenomenon, and also potential of weaponization of economic leverage, and what does it hold for Europe?
Thank you. Can you hear me? Yes. Thank you very much. Before jumping into the place of Europe in this debate, I'd like to take a bit of a step back, because I don't think I agree completely with the statement that we wouldn't be here discussing that if it was not for China. And in particular, I'd like to wind us back to, I think, what has started the fragmentation in the international monetary and financial system. And it's in particular the willingness to regionalize financial safety nets, in part as a result of the Asian crisis. If you remember 1997 and the Asia crisis, the whole of Asia undertakes an important set of reform and shocks under pressure from the IMF. and basically promises that it will never do that again. And I think this was an important shock, an important perception in Asia that the IMF was lacking both input and output legitimacy. And from that moment onwards, Asians started to develop an alternative safety net with the Chiang Mai Initiative, which then ended up being very dominated by China. This was followed in Europe by a very similar move, in fact, with the euro crisis, where the Europeans also developed a number of European safety nets alongside the IMF. Not because the Europeans felt, unlike the Asians, that they were not well represented inside the IMF, but because they felt they also needed to create some regional financial safety net. So, and these developments took place almost irrespective of China. So I think we were already from the late 90s on a path of slow and gradual regionalization of the international monetary system. And this was potentially very compatible with international cooperation, but also created risks of friction. The one thing I agree completely on is that the international monetary and financial system is still dominated by the dollar and still fundamentally underpinned by the dollar system. And in particular, what underpins the dollar system is a web of bilateral swap lines that basically allows to supplement dollar liquidity with public provision of liquidity by the Federal Reserve. The important fault line in today's international financial architecture is that there is no bilateral swap line between the Federal Reserve and the PBOC. And so basically there is an important fault line in the system, which is that if and when China were to need dollar liquidity for a reason or another, and given that its banking system has large dollar-based assets, it may be in a position one day to need this dollar liquidity, there could be a real problem in the financial system. And it's very unclear that the IMF today is fit to provide financial assistance in that context. I think that's a very important fault line. And it puts Europe in a very strange position because, in fact, the ECB is the only one to have a bilateral, not the only one, actually, the Bank of England too, to have a bilateral swap line with the Federal Reserve and with the PBOC. And so it could put Europeans potentially at that pivot position between the US and Europe. I think the regionalization of the financial system is an important dynamic and one that potentially upholds the emergence of the euro and the renminbi, first as regional hegemonic currencies, but potentially in the future as real international reserve currencies that could challenge the role of the dollar. I think when we talk about the potential challenge to the US dollar, everybody laughs and thinks that the dollar has been unchallenged for 70 years and there's no reason why it would be now. I don't think the challenge to the dollar necessarily means the complete demise of the dollar. It could just mean a system that is organized around a number of important regional currencies, and that need not necessarily be a conflictual system. So I think the big question in my mind for the organization of the international monetary order is whether we can organize a multi-currency regional order, or whether a multi-currency regional order is by definition a conflictual one. And I don't think it has to be. And this, I think, the big difference between a multipolar system and a multilateral system. I think we can completely organize a multilateral system around several international reserve currencies. Now I'm moving to Europe in particular because I think where I agree that this discussion on fragmentation is taking a profoundly new turn because of the role of China, and this is what Paula was mentioning, is I think it forces important choices. And to some extent, the choices between the US and China have been made. The US has decided quite clearly to reduce its economic dependency quite profoundly on China. It's not clear exactly how far it will be able to go because there's always a gap between the policy intentions and the policy delivery, and it's, I think, the reality, and this is supported by the data and the report that was mentioned, the reality is that the level of integration is so deep and profound that even with strong policy steps to de-risk, you will still stay with a very integrated bilateral relationship. I think the question is a lot more difficult for the Europeans. Because Europe is a lot more dependent on Chinese demand, And so for Europe to basically take the decision to de-risk would have a much greater economic cost than it has for the US. And B, because it is not clear to many in Europe whether we can or we have within reach an alternative economic model. Europe, and Germany in particular, has been built on a largely export-driven model fueled by Chinese demand. And if we were to change this, we wouldn't know exactly today how to go about it and how to turn around our economic system. I think these discussions are very acute today in a few areas, and they have emerged in part as a response to the Inflation Reduction Act in the US. How are the Europeans going to respond to, for instance, a wave of Chinese electric vehicle flooding the European market? Are we going to keep the bilateral trade relationship with China unchanged, or are we going eventually to impose tariffs on these goods? And we've had this discussion also in Europe when discussing the Net Zero Industrial Act, where we're essentially in Europe trying to set local content rules for the production of PV, electrolyzers, and wind turbines. Basically, are we prepared to reduce our dependency, or do we want actively to reduce our dependency by way of an aggressive industrial policy on China, or are we still going to trade heavily with China? I think these questions in Europe are live, and I will maybe conclude with that. They're live because they're not only economic policy questions. They are more fundamentally, in fact, geopolitical and geostrategic issues. And I think in that sense, the real balance that the Europeans are trying to find is to keep an arm's length relationship both with the US and China, in large part because there is a growing level of uncertainty in Europe about where the US is going to be a year from now, but in the future too. I think so. For the Europeans, the response to the fragmentation is fundamentally a geopolitical question mark, and there are people in Europe who want to believe that the US will stay engaged in Europe and stay committed to the global trading system, to the multilateral rules-based order. And others, and I happen to be one of them, who are skeptical about that view and who think that more and more the US has given us the evidence that they're walking away from that they are prepared to undermine the WTO whenever necessary, they're prepared to act unilaterally when necessary, and that therefore the Europeans should be careful not to cut all their economic ties, in particular with China, in an environment where the United States might become a less reliable partner. Thank you.
Thank you. Thank you so much for this insightful. Actually, the position of Europe, as you said, is quite difficult, stretched between the history and the historical relation with Europe and the future that seems to be with Asia and China. Now we'll turn to our speaker, Mr. Ralph Osa, who is the chief economist of the World Trade from the World Trade Organization. So, what is your own assessment of this issue from your perspective, and how your organization actively is working to avert the worst case scenario?
Well, first of all, thank you very much for inviting me to be on this panel. And let me start by agreeing with Paula that we also when it comes to trade, at least. We also see that world trade is in general doing relatively well. We don't see any strong signs of deglobalization. So I think it's important to keep in mind when we talk about fragmentation, that the overall picture is still quite good. At the same time, I also want to disagree a little bit, or at least caution or emphasize a little bit more also the downside, which is that we do see some first signs of fragmentation, and we have documented these first signs in two of our recent reports. First, the World Trade Report that we issued last month, and just last week we issued our trade forecast. But it's not just a trade forecast; it's also a look at recent trends. We call it Global Trade Outlook and Statistics. And in both these publications, we document first signs of economic fragmentation. So just to give you an example, one thing that we do is we look at voting patterns in the United Nations General Assembly, and based on these voting patterns, we split countries in two hypothetical geopolitical blocks. So you don't have to take this too seriously. It's basically just a standard measure of foreign policy similarity to kind of get a sense of, you know, what the geopolitical fault lines would be. And in the World Trade Report, what we show is that since the beginning of the war in Ukraine, trade between these hypothetical blocks has grown 4 to 6% more slowly than trade within these hypothetical geopolitical blocks, pointing to first signs of friendshoring. Similarly, you know, when we look at the share of U.S. trade with geopolitically aligned countries, it's significantly higher in the first half of this year than it was in the first half of last year. So now it's at 77%. Last year it was at 74%. So again, I don't want to overemphasize this. You know, international trade is clearly thriving in many ways, and I don't want to argue that we're facing some significant deglobalization, but at the same time, you know, I do see some clear warning signs out there. Now the question is where is this coming from? And I think, you know, underlying this all is really a fundamental departure from the trade affirming narrative that has been underlying the international economic order since the creation of the GATT in 1947. And the way I see it is that, you know, it's widely acknowledged, I think, that international trade brings about large economic gains. I think what's different now is that people are beginning to argue that we need to give up some of these gains in order to pursue some more important policy objectives, in particular to maintain peace and security, in particular to reduce poverty and inequality, and also to achieve a sustainable economy. So in some sense, people are arguing, you know, that trade on the one hand and these important challenges that we are all facing on the other hand are in contrast to each other. And that's also understandable. You know, Paula has mentioned this. Also, you know, we had various crises. We had the COVID pandemic that has highlighted the importance of resilient supply chains. You know, we had we have the climate crisis, you know, where people ask themselves, is trade really compatible with the need to decarbonize the economy? But we also had these tectonic shifts in the global balance of economic power, the rise of China that, you know, my co-panelists have also mentioned. That has put pressure on, you know, workers in some industrialized countries, for example, the United States. So what we do in our World Trade Report, and I want to talk about this a little bit, is really asking, you know, beyond the economic gains from trade that we all know are there, you know, what is really the role of international trade in building a more secure, inclusive, and sustainable future? And the main conclusion from our report is that we need to embrace international trade instead of rejecting it if we want to tackle these major challenges of our time. So what I'm trying to say is that the costs of fragmentation, so if you turn this on its head, you know, the costs of fragmentation are not just economic, but they go beyond that. I think they're going to undermine our efforts to build a secure, inclusive, and sustainable future. So let me perhaps discuss a little bit, you know, why this is so, and let's maybe start with economic security, or with security more broadly, but let me just focus on economic security, so resilience, you know, the resilience of international supply chains. So it's true that during the COVID pandemic, we saw how vulnerable we are to supply chain disruptions in other parts of the world, but it's also true that international trade was absolutely instrumental to helping us get through the pandemics. You know, if you look just at the growth rates of trade in medical goods, for example, trade in medical goods rose by 16% in 2020, trade in personal protective equipment by 50%, trade in face masks even by 80%. And I mean, we all know it, you know, if we had to work from home, we needed to order a computer, we needed to order a desk and so on. So really trade, I think, was absolutely crucial to getting us what we needed. But also if you look at the war in Ukraine, you know, many people were concerned, and I think rightly so, about food insecurity, in particular in Africa. And I'm not, you know, trying to suggest that, you know, that this is not an important concern, or that the war in Ukraine didn't make things worse for many countries. But what we also document in our report is that trade in many ways helped countries cope with this shock. So Ethiopia is an interesting example. Ethiopia was very exposed to wheat imports from Russia and from Ukraine. They fell obviously quite substantially when the war began, but Ethiopia was able to, pretty quickly import from alternative sources as diverse as Argentina and the United States, which suggests that really having access to outside options, outside options is really what you need in a crisis, and a rules-based open multilateral trading system is exactly what gives you these outside options. Now, if we look at inclusiveness, it's the same story. So I'm not trying to deny that the rise of China, caused some problems in industrialized countries, in particular in the United States. But I also want to make clear that there's, if you look at the cross-section of countries, there's no clear correlation. Basically, there's no correlation between domestic inequality and openness to international trade. There's many countries out there. Germany is an example, but there's many others that are very open, but not so unequal. But I think more importantly, when we think about the rise of China, what we also have to remember is that, trade was instrumental to the rise of China, and the rise of China in turn lifted hundreds of millions of people out of poverty, providing hope to people around the world. If you look at any, measurement of economic well-being out there, they all came down dramatically in the last decades, not only but also because of the rise of China. So just viewing this through the lens of what happened to American workers, I think, is a bit of a narrow perspective on that. Which goes to say that I think trade, if you think about it a little bit more broadly, is an important driver also of inclusiveness, because it literally helped hundreds of millions of people escape poverty. And lastly, when we think about sustainability, let me maybe also say that briefly, when people think about trade and the environment, they think about trade and transportation, and they think about ships and trucks and plane and all the emissions that come with them. And that's important, and obviously I'm all in favor of decarbonizing the transport sector. But I think what we also have to realize is that there's more to emissions than just transportation. In particular, there's also production emissions, and there's large variation in production emissions across countries. So in general, trade can also be good for the environment to the extent that you import something from a relatively green origin, because then you save more production emissions than you actually incur in terms of transport emissions. Could also go the other way, but in general, there's no, it's not that trade is bad for the environment. And one thing that we show, which I think is actually quite interesting, what we show is that trade can actually be a very powerful force multiplier for climate policies. So we do a simulation where we say, imagine the world imposed a carbon tax. So imagine the economist's dream comes true, and we have a worldwide uniform carbon tax. Then one thing that this tax is going to do is it's also going to incentivize this green sourcing that I just talked about. So it's also going to incentivize that countries basically specialize in the industries in which they are relatively green at, which is also going to bring about some environmental gains from trade. And what we show is that these environmental gains from trade are responsible for more than 1/3 of the emissions reductions that are brought about in this hypothetical scenario. Meaning that trade is really a powerful force multiplier for these climate policies. So, shutting down trade, is really not the answer, I think, when it comes to sustainability or saving the environment. So then just briefly, you also asked what we do. And, WTO members have actually done, quite a bit, I think, in the past years, perhaps not always so noticed by the public or in the press. So on the multilateral level, we had the trade facilitation agreement, we had the fisheries subsidies agreement, I think two, very important multilateral outcomes. And may I say, the last one, was reached last year amidst all this geopolitical fragmentation, and China had to agree, the US had to agree, Russia had to agree, Ukraine had to agree, and somehow they all came together and proved that multilateral outcomes are still possible. But we also had, progress in plurilateral negotiations, so negotiations among subsets of WTO members, for example, on services, domestic regulation, investment facilitation, basically, making services trade, making investment easier on the ground. And this all sounds a little bit abstract, but if you take the trade facilitation agreement, it's not the most exciting agreement, I admit. It's about basically making crossing the border more efficient. Yeah, so it's not something where it's not the most sexy topic, perhaps. But our estimates show that this has really made a big difference, in particular for developing and least developed countries, because this is exactly where trade facilitation is most urgently needed and where goods are often stuck at the border. So if you look at least developed countries, it has, I think this is for all countries combined, yes. So the trade facilitation agreement has increased trade flows by $231 billion. And the vast majority of it has accrued in least developed countries and in agriculture, because this is where these barriers are particularly important, because produce goes bad and so on. But just to conclude, I also don't want to suggest that there's not much more work to do. So when we look at trade costs, so we have a way to measure trade costs in a relatively general way, and there what you see is that trade costs facing developing countries are still very high. Trade costs in agriculture are still very high. Trade costs in services are still very high. So there's clearly still a lot of work to do. And liberalizing services trade, liberalizing trade in agricultural goods, and also giving developing countries better market access, be it through through reducing tariff or non-tariff barriers, would clearly be policy priorities for the future. Thanks.
So thank you so much for these insightful elements. Actually, as you said, the inclusiveness, the economic security, and the sustainability, those will be the focal points of the international trade system of tomorrow's, was also of today's, and that role that you mentioned being played by the WTO in order to advance in the multilateralism agenda. Now we'll turn to Mr. Eric Bergloff, who is the chief economist at the Asian Infrastructure Investment Bank. So I will ask you, in a scenario where fragmentation is, let's say, is pushed to the limits, who stands to be the biggest loser? I'm not daring to say who's going to be the winner, but I expect that there is no winner in such a situation. But how might also our collective efforts towards common goods, like the fight against the climate change or broadly sustainability, can jeopardize? You can also talk about different initiatives that you say that we can undertake in order to de-risk our global economic relations.
Yeah, thank you, and thank you for inviting me to this very interesting panel. I guess I'm last to speak, so I have to pick up the crumbs of the others, and so I was going to focus on a couple of things that have been said, and maybe try to develop them. One is the kind of statement that we don't see so much fragmentation. We are seeing some fragmentation in capital flows and in trade, but not as much maybe as the sort of media discussion would suggest. And then I would say something about de-dollarization, but in quite a different sense than it has been used so far in the panel. So obviously, and I think so much interesting things have been said about the significance of global trade and the importance of particularly in working as I do in Asia, the amazing things that trade has brought to Asia, and the possibilities for many countries, and not only China, so many countries to join global value chains, to be part of international trade patterns, and when I look at the data, and I agree that we don't see so much yet, but when I look at some other types of data, for example, surveys to companies and so on, there's a lot of evidence that this is really profoundly being reconsidered, that this issue of de-risking, decoupling is very much in the minds of corporations in Europe and in the US, and I would say also in parts of Asia. And of course, it can work both ways. It's looking at what's happening to your competitors or your suppliers or your customers. So it's understandable that this is on people's mind, but I think the pressures are very real, and we should be lucky, I think, that these global value chains are actually quite, as a form of trade, they are very slow-moving, and in the sense that they are, these are very specific arrangements, and we call it sort of very relationship-specific, and they rely on trust along very complex value chains, and in each interface between different stages of that value chain, there is something like really personal relationships that have developed. So shifting out of this and also developing parallel value chains or parallel options is also very difficult, because the efficiency pressures on these value chains are extraordinary, and I mean, of course the gains that have been had from these value chains are truly extraordinary. But it is also true that these risks of disruptions, and as we saw in COVID, and as we think we are seeing now, also I would argue when it comes to decoupling, that those risks have maybe not been fully internalized in this structure. So in my mind, what's going on right now is a sort of reassessment of these value chains. We don't see it much yet, but it is there. So what are we risking when we are de-risking these global value chains? I think there are two fundamental things. One is that to the extent that we make it more costly, more difficult to organize these kind of global value chains, we are taking away, or at least reducing the power of this leverage that have been so important for bringing so many economies, particularly in Asia, but across the world, into global production arrangements. If you look at over the last 15 years, what's really striking is how emerging and developing countries have entered into this world, and advanced economies, the share. And it's not just about China. The rest of the world has increased their share as much as China. And I think that is something that we really need to take into account when we think about the consequences of what's going on. The other aspect, which is, it relates a little bit to what Ralph was saying here, but it's, one capacity of these global value chains that we haven't exploited fully yet is the capacity to achieve decarbonization. These are the very fundamental aspect of these arrangements is they impose standards along the value chains. These are standards around information flows, around product specific product qualities and quality of services and so on. These standards are the very essence of these global value chains. And this is exactly the standards that we'll need for decarbonization, and I would also argue for saving biodiversity and so on. So to my mind, if we are really entertaining this idea of devolving these global value chains, it will come at some very considerable cost when it comes to global development and to our capacity to decarbonize. I would even go as far as to say that there's probably no more powerful mechanism for achieving decarbonization across countries. We have the Paris Agreement and so on. It relies on peer pressures and so on, but it is not powerful enough, as we have seen. Here we have an instrument that we really should think of how can we exploit much more. And we know that these lead firms, these are governance arrangements. These lead firms are what they do is that they govern along these value chains. They have made extraordinary commitments when it comes to going to net zero. We may have different views on how realistic some of these and how deeply thought through these commitments are. But let's hold these companies to these commitments, and I think we will have a very powerful mechanism for decarbonization. so maybe so I said I would say something about de-dollarization also. So for me, the really worrying thing about this battle that we have now with climate change and bringing along the emerging world in this battle, because I think there's no alternative. Actually, I had a chance to speak at your parallel event here yesterday, and I was phrasing and saying that this is really a fantastic opportunity for the emerging and developing world to receive capital flows on a scale that they haven't seen for a long time. If they are willing to adopt some of these policies that are needed and undertake some of the reforms. And it's many of the reforms that are needed are traditional reforms, like restructuring state-owned enterprises that are in most of the world, and certainly in Asia, heavily overrepresented in the fossil fuel industry. The same thing looking at the financial sector, state-owned financial institutions that are so important throughout Asia. They are heavily overexposed to fossil fuel. All those reforms are going to be essential, and being convincing about it to the sources of capital, whether it's MDBs, whether it's bilateral flows, whether it's private sector. All these reforms are going to be absolutely essential to bring about. So let's grab this opportunity. But the other side of that, and this is where de-dollarization comes in, almost all of that is now happening in dollars. And that is, to me, a very scary proposition. We're going to build up dollar exposures, because we want these countries to adopt renewable technologies, and which they should, and which will be in their interest, I would argue, certainly in the long term. But in that process, we are risking building up very large vulnerabilities. So we need to think very seriously, how can we de-dollarize these? I mean, and here I'm not talking about, it's not about dollar versus other currencies, it's about local currencies. How can we make sure that all the investment, because all the revenues from these renewable energies sources, and so on, they will come in local currency. I work for an infrastructure investment bank. All our revenues, more or less, are in local currency. It's not responsible to just continue lending only in dollars, or renminbi for that matter. So we really need to think about how can we achieve progress here. And there are three, at least, maybe more, but certainly three very concrete ideas on the table. We should look at those, and I think they're complementary. And I won't go into them now, but I think they are all of them have their own very interesting features, and they offer a possibility to, or some of them at least, offer opportunities to move towards local currency, but also in the process help developing the local markets for capital in these countries. Because if we don't do that, having this massive flow of climate-related investments in these countries could end in a major disaster. Thank you.
So thank you so much. So I like your idea on the role that can be played by firms in terms of fostering and advancing the idea of decarbonization as they organize the global value chain, which is extremely important. Now we will open the discussion to our audience. So yeah, please, and then you. So we'll gather 3 questions, and then we'll ask our panel. Please introduce yourself.
Christian Kopfit, Union. Eric, you got us all excited. We want the 3 ideas.
Should I say something?
Yeah.
Well, so I, thank you, Christian. So it wasn't agreed that you would ask me this question. But so there are 3 proposals. That's something that probably most of you have come across. It's the Bridgetown Initiative, which basically says, the fact that all these countries have to borrow resources or borrow to finance these climate investment. They focus on the large emitters, and that is becoming extremely expensive for them. And they would even argue that it's the premium in these economies is excessive, and actually they make an economic argument that if we can provide guarantees, bringing down the costs, that can be defended also on economic grounds, not just on fairness grounds. So that's one idea, to basically reduce the foreign exchange risk by guaranteeing this. And I'm not giving full credit or full justice to the sophistication of the proposal. The other proposal is to use something called the TCX, and many of you will be familiar with it. It's basically there. It's like a pool of currencies, and they're not perfectly correlated, so you can actually bring down the cost of hedging in individual currencies, mostly for smaller, more sort of less traded currencies. The third proposal, which is the one that I think is the most interesting one, is the one where MDBs, also multilateral development banks, and development finance institutions would come together in individual countries. So the idea is to create an entity that, now I'm getting a little technical, but an offshore entity so that could trade onshore. So what you do is that you establish maybe a number of development finance institutions, MDBs, go together, establish this entity, and capitalize it so that it gets a sufficiently high rating, and then delegate our treasury authority. So, for example, AIB would say, everything we do in this particular currency, say in Bangladesh, we would delegate to this entity to handle liquidity needs. So that would allow us to have a much more flexible and we don't have to, what we do have to do now is that every single transaction we have to have back-to-back protection. And that becomes very costly and very cumbersome to work with. So doing it this way, we could, I think, find a much more, and a way where we would have an interest in actually helping this country to develop the capital markets, because that would facilitate and make these treasury activities less costly. So that's the idea. It's still just on the table. There will actually be a discussion right after this in the MDB Treasurers Forum of this idea. They have actually devoted the whole afternoon to local currency discussions. So this is a very live topic, and one that any other ideas? I know Citibank also has an idea in this space. Let's get all the ideas on the table, and because I think this is going to be one of the most important issues going forward.
Oh, thank you. So we'll move to the second question. Yeah.
Is it working?
Yes, it is.
It's working.
My name is Christina. I am from the QIA. I have a question for Shaheen Waleh. So I have a question on EVs. So as I understand, the current EU tariff on Chinese EVs is 10%, and this compares to 27.5% in the US. So how can we explain that? Like, can we say that Europeans are foolish? And a related question, do you think the EU will increase the tariff?
Thank you. So we'll move to the third question and the fourth, and then we'll give the floor to our speakers to answer and respond. No.
Sorry. So I wanted to ask the same question on what were the three ideas, but since it was answered, maybe a question to Shaheen on the role of swaps. Do you see them as tools of, the Fed sees them as sort of crisis prevention. They also have this geopolitical element, and especially for the EU, how could they use them, both as crisis prevention and the spirit of geopolitical commission as a geopolitical tool?
So the third speaker, and then we'll move to you.
Thank you. I'm Santiago Fernandez de Lis from the DDA. I have a comment on the risking and another one on the dollarization. I wanted to know your views. On the risking, it seems to me that the term was used initially referring in particular to correspondent banking, and related to AML, extraterritoriality, and the reluctance of banks to assume risk in this type of operations. And it seems to me that banks are becoming extremely risk averse in some of these operations, and these risks are moving to the non-bank financial intermediation system. So what are the implications of this shift of risk, and how can we monitor them? And on this dollarization, I mean, again, I think we need to distinguish between different uses of reserve currencies. I mean, it's not the same using a currency for denomination of trade or for international capital movements, or for foreign exchange reserves, or for store of value for citizens. So to me, in some of these areas, it is clear that competition between different countries is good, and in other cases where there might be more kind of threats to the present system. But I would like to know your views about in which aspect do you think de-dollarization is a problem, because in other areas we already have competition and this is fine. So we have a dominant currency, but we have another currencies that are already there. So yeah, that's my question. Thank you.
Thank you. So Mr. Shaheen, so the first two questions were directed to you, and the third one will split it across our speakers.
Thank you. Maybe first a question on swap lines, which I think is important. Indeed, there are different kinds of swap lines. If you think of the swap lines of the PBOC, most of them are in fact designed for trade facilitation purposes, and I think answers the question on de-dollarization as well. In fact, what the PBOC has tried to do mostly by developing this network is to facilitate trade and invoicing in renminbi. But maybe this was viewed also as a first step to enhance the denomination of trade in renminbi before expanding its role maybe in capital markets. And then you have the alternative, which is what Martin has mentioned, which is swap lines viewed as basically backstop to the financial system, and this is mostly the Fed backstop, the Fed swap lines sort of underpinning the dollar system. Europe is in a strange position because it could do, and maybe should do, both types of swap lines. It could expand the role of the euro in international trade, maybe by providing, in the same way that the PBOC does, more swap lines to facilitate trade in euros. And it could also play, I think, a bigger role, in particular regionally, to backstop local financial system in and around Europe. And Eric and I go back a long way, and one recollection I have is the crisis in Eastern Europe at the time, where I think the ECB could have played, for instance, a much more active role in providing euro liquidity to Eastern European countries. And in part because the ECB didn't do it, alternatives had to be found in the name, for instance, of the Vienna Initiative that Eric was a very important player in putting together. Just for you to remember that, at the time, Latvia, which was a country inside ERM2, not yet a euro member, could not get a bilateral swap line from the European Central Bank, and the European Central Bank instead delivered a swap line to the Riksbank in Sweden, and Eric would know that well, and then the Riksbank in Sweden provided a swap line to Latvia. So I think these are examples to illustrate that I think the swap line system revolving around the ECB could, I think, be made a lot more solid. And one current example I'm thinking of, for instance, is potentially extending a bilateral swap line between the ECB and the National Bank of Ukraine. And this has been in discussion, and the ECB has decided not to do it. So I think that could be the sort of thing that I think a geopolitical European Union would endeavor to do. But I gave the example of Ukraine, but I could also imagine doing that to, why not the Central Bank of Morocco, for instance? So these are I think, avenues I think that the Europeans should explore. Now, on the difficult question of EVs, what is going to happen? So, as you know, the European Commission has started an investigation, and as part of this process, it will try to identify and quantify how much subsidies EV producers in China are enjoying. And after that assessment has been made, the European Union could decide to increase its level of tariff on EVs. As I said earlier, I think it's a fundamental economic policy decision, which I think has also deep geopolitical implications. I suspect that this is not a decision that will be taken before the U.S. election, in part because I believe that this is something that, that the result of the U.S. election will weigh on how the European, views these risks and these in these trade-offs. And also because I think it would set a precedent, because if we impose tariffs on EVs, we probably will end up doing the same on electrolyzers, on PVs, on a broad range of other green tech and maybe other goods. So could be the beginning of an escalation that that I think the Europeans should beware before undertaking. And that's it.
Thank you. So, Paola, if you want to comment.
De-dollarization, I think it is an imprecise term. So again, we use it normally to indicate countries, normally developing countries, then tend to have the domestic financial and banking system too exposed to the dollar. So again, deposits in dollars, domestic savings in dollars. And so it's a process of reducing this dependence and vulnerability. I think de-dollarization, I understand some people use it as a movement in the international monetary system away from the dollar towards other international currencies. So the issue is we're talking about domestic currency and the need for small countries to be more, to use their domestic currency in trade, in particular in financial transaction, and the thing that Eric referred to. The other thing is which type of international monetary system we have. And back to the point that Shaheen made at the beginning, we are already regionalized. I mean, the Chinese renminbi made amazing progress in less than 15 years. So now is the 30% of bilateral trade, China bilateral trade is settled in RMB. 15 years ago was a very tiny percentage. And the RMB now is the 5th or the 6th exchange every month. Most used currency in international payments. 10 years ago, it was the 25th or 27th. So again, huge progress. And now I publicize a book, and I wrote a few years ago called The People's Money, How China is Creating Global Currency. I should have been probably regional. To tell you again how this process is happening or has happened and is a policy-driven policy. It already is a strategy, and I was rebuffing China to talk about renminbi strategy. Is a policy-driven because the capital accounts is managed, and therefore liquidity is managed by the Central Bank of China. And that creates a big constraint on the renminbi as an asset, as store of value. And that's all the attempts that were made to create offshore markets, renminbi offshore markets around the world, except obviously in the United States, have been, interested in infrastructure, interested in developments, but they haven't delivered the expected result because of the control on capital. But anyway, this is an interesting, and there'll be a lot of progress. Now, the renminbi is effectively a currency that has take up very substantially in international trade and will continue. Now, the thing that people ask is, will the renminbi rival the dollar? Will the renminbi become the key reserve currency? That's not the question. And the question was off the table a long time ago. And in many occasions, the Chinese leadership made it clear that that is not their objective. The objective is actually to create a multi-currency international monetary system. And that objective was defined in a very clear way by the then governors of the People's Bank of China in 2009, when actually made it clear what the international monetary system should look like and be reformed. So there is no rivalry with the dollar. The world is a multi-currency system. Now, the key question is how stable, how can we manage this multi-currency system? In particular, if we got a fragmented trade and financial system and fragmented global economy where we cannot find a way to cooperate, or international cooperation becomes difficult. And the point I was making about China is the only country that can create a new system. Again, he has already proved that he can create institutions. Eric works for the AIB, which is proved to be a very good institution driven by Beijing. It has, created bilateral, again, swap agreement. We talk about that. The China initiative is tiny and untested, and I wouldn't even consider that. But the problem we have at the international level is, yes, we don't have a robust and extended international financial safety net, and that should stay with international institutions. But we know that the governance of the IMF and the contributions and the quotas are a very difficult topic to discuss, and mainly because of the main shareholders. So again, we are a bit stuck here. But the point is, fragmentation means that we cannot cooperate. We end up with different set of rules. And the risk is we stay integrated because dismantling what we have created is difficult, but in a fragmented way. And so Eric is absolutely right. Corporations have on their radar, on their screen, the issue of decoupling. But they also know that decoupling is very expensive, because for some of them means literally dismantle physical infrastructure. And so decoupling is expensive, while de-risking is actually smart.
Thank you so much. So, Ralph?
I don't have that much to add. Just a quick point on the de-risking, because it has the de-risking of the financial system, because it has important implications also for international trade, because international trade, it came up briefly in the discussion before, is very finance intensive. And we have some interesting, I think, studies together with the IFC, the private sector arm of the World Bank, where we look at the so-called trade finance gap. So the difference between, trade finance that's requested by businesses and trade finance that's actually provided by banks. And what these studies conclude is that in many developing countries, this trade finance gap is huge. So we have one study that came out last year on a bunch of West African countries. And, just to give you one statistic, there what we find is that only 25% of exports from these countries are supported by trade finance, whereas in rich countries, that's 60%. And of course, the more you de-risk the financial system, the more or the less willing banks also to engage in this type of lending. So there's also repercussions, I think, potentially important repercussions on the real economy in that sense.
Thanks. Eric, if you have anything to add?
No, I just wanted to actually bring up something that Ralph was mentioning before around the the incentives of trade. So I mentioned the role of these lead firms in global value chains, but I think your point is much more general, I think, and that we can use this as a mechanism for moving the climate agenda along. We have this CBAM, which is now, of course, getting a very bad rap in many emerging and developing countries. So we need to think about how can that tool be used in a right and fair way, and that, to the extent that it is used, I think we need to think about how can we compensate countries and again use the compensation to stimulate this kind of investments. But I just think that trade here, both GVC type trade, but also more generally, trade can become a very powerful tool to drive this development.
So we're going to take a second round of questions, if there are any. Yes. Go ahead.
No, yeah, it works. Hello everybody, to the esteemed participants of the panel. My name is Ekaterina Kozyrova. I'm a president of IC International, a think tank based in Paris. And actually last year we issued a publication together with Mark and the Bretton Woods Committee and this Center for European Policy, touching exactly all those issues, but also referring to one that is completely neglected, unfortunately, in all IMF talks and even more World Bank talks here. Even during this session, unfortunately, when talking about fragmentation, wouldn't the first solution be to restore the physical continuously of the space? So I'm coming to the subject of connectivity. What is the difference between the Chinese policies and the US policies, also the European policies regarding these issues? Is that what China does, is that they are structuring the space with the crystallizing structures like transport corridors, economic corridors, and thus, even despite all challenges and constraints, they've got the crystallized structures that are already working. What we can see right now, after the Russia's invasion of the Ukraine, still the northern corridor, the northern rail corridor, is #1 choice for transportation of goods between China and Europe. US actually do not invest largely in capital-heavy and complicated structures, and Europe, unfortunately, has abandoned this path, focusing now much more on regional issues. So maybe one of the ideas, and it would be interesting to know your perception of this idea, would be also to consider the physical connectivity prior, or at least together with all such things as financial connectivity and trade connectivity. Thank you.
Thank you. So if you don't have any other questions, I'll give final choice to our panelists to react or to comment or to conclude. So please, 3 to 4 minutes, no more than.
I am no expert on physical connectivity, but I believe that you've mentioned rail in particular. I think for Europe, more than rail, sea connectivity is what matters the most. And I think in that field, and maybe that says something about de-risking, the Europeans continue to invest massively in sea connectivity to Asia and to the US. So maybe that's a sign, echoing what was been said earlier about the trade numbers, that we don't see as much fragmentation as that. I would like to add something to, I think, the question that was raised earlier on de-dollarization and correspondent banking, and what you've said about de-risking. Because I think there has indeed been a very high level of fragmentation affecting mostly the least developed economies as a result of the complete breakdown in correspondent banking channels. And this was not done at all with the view of de-risking in the sense that we've used it in this panel. This was absolutely done, as you rightly said, with a somewhat epidemic fear about AML, sanctions, and extraterritorial action from the US government. And there's been some policy efforts to undo that, but they've all been they've had very limited effect, sadly. So we remain, in particular, and I think that's mostly the case of Africa, with an African continent that has been largely shut from correspondent banking, in reality for no very good reason. I mean, I'm not disputing entirely the fact that there were and there are existing AML concerns in some parts of the continent, but I think that has really damaged and fundamentally increased the cost of transaction, the cost of remittances, and the cost of investments for the least developed countries. So I think that's an important area, and I think you can very well pursue a strategy of de-risking while continuing to bank with the least developed countries. And in fact, if I understand well what has happened in Morocco, in large part because European banks were withdrawing from the African continent, this has become a great opportunity for the Moroccan banking system to take this space and to actually play the role of sort of banker of Africa that maybe Europeans had decided not to do anymore.
Actually, this is what happened in the African, especially in West Africa. French bank withdrew, and then there was an opportunity for Moroccan banks to settle there, and as they have the knowledge to operate in very tiny markets, where low middle income economies, the dynamics are not so different from lower middle income economy and lower in the Moroccan economy. Miss Paula.
Much about it, but it's an important point you made. And it's an important point because, again, it ties with the discussion about vulnerabilities. And this is something that we forgot. And I remember 15, 20 years ago where we all discussed management models of like just in time, the idea that you could actually put in your shop goods that were made couple of days before, literally in response to demand, somewhere in the world, obviously not too far away, but not basically around the corner. And that was supposed to be a resilient model. And we know that is, I mean, it's a model, but is obviously vulnerable to physical bottlenecks. And we know that are there. So then again, vulnerability is not only towards, let's call it a hostile geopolitics, but also to physical impediments in the supply chain. So again, that's very, very important. The Chinese have used a lot of this, absolutely. As a wrap up of this session, what do I take home? The two issues, one is again, the importance, back to my point around the dollar, still gluing the world economy together, is the importance for countries to use and the legitimate sort of wish to use their local currencies. And again, the development of central bank digital currency will be helping this use of local currency and reduce the cost and the risk of being too dollar based. The other thing is, we heard it this morning, the last session of the morning before lunch, the discussion about sanction, and actually discussion about the premium that some countries need to face as a result of potential sanctions. And so this is an important point, and again, at the multilateral level, we need governance of financial and monetary sanctions. They cannot be left to the initiative of the issuers or the key reserve currency, and it should be a way to govern the use of sanctions, so that they are not arbitrary. There are rules around it. They're used appropriately, and they're used in an effective and let's say focused way. Thank you.
Thank you, Mr. Wolf. Any message of optimism in this cloudy context?
I mean, so the first message is that we do actually think about physical connectivity quite a lot, mainly in the digital space, because one thing that we keep saying is that the future of trade is digital, and in particular in digital services or digitally delivered services. It's such a tongue twister, I can never say it. Because you've seen a very rapid growth in that over the last few years. So since 2005, trade in digitally delivered services has grown by 8.1% per year on average, outpacing trade in goods and trade in other services. And then, you ask yourself, well, if that's where the future is going, how do you make your country, and how do you make your country ready to reap this opportunity, which, by the way, I think is an important opportunity for many African countries, where you can potentially leapfrog this industrialization process and go straight to a services-led growth model. Morocco, by the way, I think is doing pretty well in that space. But then when you start thinking about it, you realize, well, it's the tariffs that are important. And we're working on those, but it's much more than that. You need the right infrastructure, you need the right skills, and there's currently a huge digital divide. So if you look at the fraction of people that are online in developing countries versus developed countries, I mean, it's a huge difference. And if you're not even online, of course, you cannot take advantage of these opportunities. But I also wanted to return the favor to Eric, because I think this idea that you put on the table about the lead farms being really important, I think it's a really interesting one, and I hadn't thought of that, and I'll take that home for sure. Because, I mean, the whole problem with the sustainability debate, of course, is that, or not the debate, with the whole issue is that there's a market failure, and normally what we would need is governments to step in with the right policies, and if you have these policies in place, then you can leverage this environmental comparative advantage that I was talking about, and I do think that's very important. But oftentimes we don't have the right policies in place, so we really need corporate social responsibility or individual social responsibility. But I think what you point out is that with corporate social responsibility, even then, trade can be an important force multiplier for climate change, and I think that's definitely something I'll take home.
Thank you so much, Mr. Eric Bergloff. Any ideas to share?
Well, thank you. First of all, I want to thank you for bringing in the physical dimension, because I think it's still, even if trade increasingly is in services and information, this physical component is still hugely important. And I think we were created as an institution, AIB, and it's in our DNA. And one of our 4 corporate strategic objectives is to promote cross-border connectivity. And it's actually incredibly difficult because these projects take a long time. They involve, countries or governments working together, private sector working together across boundaries. Really, really difficult. And the examples you mentioned, I think, are super interesting. This China-Europe railway was been transformational for the interior of China. Sichuan province, has benefited tremendously from this railway, and we have actually done some work showing exactly, or at least suggesting the impact of that. And we saw it during COVID. It's not so well known, but a lot. So what this brings down the time of travel or time of transport by maybe 1/3 or something like that compared to sea travel. And in COVID, possibly because of the costs of shipping went up, you will remember the container costs just went through the roof. And so what happened was that a lot of Japanese and Korean companies, they transported these exports to Chinese ports, and then they were transferred to railway and transported to Europe. So, even, it was very extreme circumstances, but there is a very real impact from that. And one thing that I'm trying to emphasize now is also to build data that makes us, so geospatial data, I think, is developing incredibly fast, and it can be a very powerful tool in trying to understand how important these physical connectivities are. And I think China has rightly focused on this. I think they, unfortunately, in the process made a lot of mistakes, and I see a lot of reassessment going through BRI. We haven't been able to work almost at all with any Belt and Road Initiative projects because they typically worked on local standards. We have to work on international standards, and I think now, many of the important Chinese actors are realizing that maybe it wasn't such a good idea, so now they are converting to using international standards. Also, when it comes to how you provide credit, they were latecomers. They did a lot of shortcuts and maybe not so good practices, and I think they are now learning from experience that we need to think in a different way. So my hope is, of course, that all these actors can come together and work multilaterally on delivering that kind of cross-border infrastructure, because I think it is, as I said, extremely difficult to do. What do I take as a lesson from this exercise? Well, the trade is, I learned yesterday, I didn't realize it, but actually you say that trade is alive and well. Yes, it is, but I think the recovery of trade after the recession now is the slowest trade recovery in history, or at least in modern history. And I think we have to realize that trade is such an important feature, and we need to make sure that it happens, in a way that serves those other interests, and when it comes to climate, biodiversity, making sure that we get the just transition and so on. All those things we need to think about, but trade is so important.
Thank you. So this is the end of our session. I'd like to thank our audience for their interactions, for their questions. I would like also to extend my warmest appreciation to my esteemed panelists, Mr. Shaheen Valeh, Ms. Paola Subaki, Mr. Ralph Osa, and last but not least, Mr. Eric Bergloff. So thank you so much, and see you.
Ladies and gentlemen, we will now take a 15-minute coffee break in the foyer behind the conference room before reconvening for the sixth session of our event.